Welcome to today's video about options trading, one of the most powerful and most misunderstood tools in the financial markets. The global derivatives market is worth over $600 trillion. More than 4.7 billion options contracts are traded every single day, and yet 90% of them expire completely worthless. By the end of this video, you'll know exactly how calls and puts work, what drives an options price, how the Greeks measure your risk, and which strategies the professionals use. Let's get into it. So what exactly is an option? At its core, an option is a contract that gives you the right, but not the obligation, to buy or sell an asset at a fixed price before a specific date. Every option contract has four key components. First, the underlying asset. This could be a stock like Apple, an index, or a commodity. Second, the strike price, the agreed price at which you can buy or sell. Third, the expiration date, the deadline by which you must exercise your right or lose it. And fourth, the premium, the price you pay up front for the contract. That four-part structure is the foundation of everything in options trading. A call option gives you the right to buy an asset at the strike price. You buy calls when you believe the price will rise. Here's a real example. Apple is trading at $175. You buy a 180 call option expiring in 30 days for a premium of $3.40. That's $340 for one contract covering 100 shares. If Apple climbs to $200, your option is now worth $20 per share, giving you a profit of $1,660, a 488% return. If Apple stays below 180, your maximum loss is exactly what you paid, $340. Your downside is always capped. Your upside is unlimited. A put option is the mirror image of a call. It gives you the right to sell an asset at the strike price. You buy puts when you expect the price to fall, or to protect a portfolio you already own. Puts are used as insurance. If you own 100 shares of Apple at $175 and you're worried about a crash, you buy a 170 put for $250. If Apple collapses to 140, your put caps your loss and protects your portfolio. This is called a protective put, and it's one of the most important hedging strategies in finance. Just like car insurance, you hope you never need it, but you're grateful it's there. What determines how much an option costs? Option premium has three key components. First, intrinsic value. This is how far in the money your option already is. A 180 call with the stock at 190 has $10 of intrinsic value. Second, time value. The more time until expiration, the more expensive the option, because there's more opportunity for the stock to move in your favor. This erodes to zero at expiration. Third, implied volatility. This is the market's expectation of future price swings. When the VIX spikes, meaning markets are fearful, options premiums explode. This is why professionals sell options during high volatility and buy during calm periods. The Greeks are the risk metrics that every serious options trader watches constantly. Delta measures how much your option price moves for every $1 move in the stock. A delta of 0.5 means your option gains 50 cents when the stock rises $1. Gamma measures how fast delta changes. High gamma near expiration means delta swings wildly. Theta is time decay, the daily cost of holding an option. Every single day that passes without movement, your option loses value. Theta is always working against buyers and in favor of sellers. And finally, Vega measures sensitivity to implied volatility. When 4 rises 1%, your option becomes more expensive by the Vega amount. Master these four Greeks, and you understand options risk. Now let's look at the strategies professionals use to generate income and manage risk. The covered call. You own shares and sell calls against them to collect premium income. The protective put. You own shares and buy puts as portfolio insurance. The bull call spread. You buy a lower strike call and sell a higher one, cheaper than a naked call, with capped profit. The iron Condor. Sell an out-of-the-money call and put, buy further strikes to define risk. You profit if the stock stays range-bound. A favorite of professional traders. The long straddle. Buy both a call and put at the same strike. You profit from big moves in either direction. Perfect before earnings announcements. And the cash-secured put. Sell a put with cash reserved to buy the stock if needed. Collect premium and potentially acquire shares at a discount. These 6 strategies form the core toolkit of every options trader. Let's recap what you've learned today about options trading. An option gives you the right, not the obligation, to buy or sell at a fixed price. Calls profit when prices rise. Puts profit when prices fall. Option premium is driven by intrinsic value, time value, and implied volatility. The Greeks, delta, gamma, Theta, and Vega, measure your risk on every dimension. And 90% of options expire worthless, so time decay is always working against buyers. Options are not gambling when you understand the mechanics. They are precision tools for income generation, hedging, and leverage speculation. Thanks for watching. If this helped you understand options, please subscribe and hit the bell so you never miss a finance deep dive. See you in the next one.